looking at a forward exchange contract designated as a fair value hedge of a foreign currency denominated firm commitment to sell inventory. Our US-based company enters into a firm commitment with Malta-based retailer on November 10, 2018. The firm commitment requires our company to sell 70,000 units of an inventory item costing €10 each to the Maltese company. Our company is contractually committed to ship the inventory, i.e. title transfers, on February 10, 2019, with payment in euros on the same date. Our company does recurring business with the Maltese company, and the firm commitment includes significant monetary penalties for non-performance. Also assume on November 10, 2018, our company enters into a contract with a foreign currency exchange broker to sell euros for settlement on February 10, 2019, to mitigate the risk of exchange rate fluctuation. Our company's functional currency is the US dollar, and our forward exchange contract qualifies as a fair value hedge. The relevant exchange rates and related balances for the period from November 10, 2018 to February 10, 2019 are as follows. Make this a little bit bigger here. So we have the date, the spot rate, sale transaction, forward rate, the fair value of the asset liability, and the change in fair value. And there's just these little notes here. A goes with this forward rate, stating that it's for settlement on February 10th, 2019, and B aligns to this fair value asset, saying ignore discounting on the computation of fair values. Prepare all the journal entries to record the sale and all adjustments required for the firm commitment and forward contract at November 10th, 2018, December 31st, 2018, and February 10th, 2019. If no entry is required, select no entry as your answers under description and leave the debit and credit answers blank. So we have 11/10/18. And on this date, there's actually going to be no entry because we must document the hedging relationship and the hedge effectiveness in the accounting system. And the fair value is equal to 0 at inception, which means there's no entry. So then on 12/31/18, we are going to account for this 35,000. And so we will have a debit to hedge firm commitment and a credit to sales. And that'll be the 35,000. Then on February 10th, 2019, we're actually going to recognize the sale transaction, and that's what they have here. We need to record the sale of inventory, then we need to record the change in value, and to reclassify the firm commitment. So we'll start with that recording of the inventory. We'll have a debit to cash and a credit to sales for the 896,000. Then it's asking us to record the change in value. And so we can just copy these accounts down. The debit to hedge firm commitment and the credit to sales for the 14,000. And then finally, to reclassify the firm commitment, we need to debit sales and credit the hedge firm commitment. And that will be for the 49,000. Okay, and let's indent these really quickly. just so that we can see the debits versus the credits a little bit better. Okay, so now down on our fair value hedge, the same thing, we're going to have no entry on November 10th. On 12/31, we're going to have a debit to sales and a credit to the forward contract, and that's your liability. For the $35,000. Then on February 10th, we have to record the change in value and record the net settlement. So our change in value will be a debit to sales. I guess we could have just copied this down. And a credit to forward contract for our $14,000. And then the net settlement will be that $49,000. This will be a debit to forward contract, a credit to cash. I'm just going to reference this $49,000 since it's in our same screen. Get rid of these underlines really quickly because it's making me crazy. And indent our credits. Okay. Then, so we have our journal entries done. B says, reconcile to the forward rate at the forward contract's inception the net cash received for both the sale of goods and the settlement of the forward contract derivative. Net cash received for the sale of goods and settlement of the forward contract derivative is, and so over here I'll just describe what we're doing. We're going to take the sale of goods and then our settlement derivative, and that'll give us net cash. So the sale of the goods was $896,000. The settlement derivative was $49,000. And so that gives us net of $847,000. C, what amount of sale was recognized in the quarter ending December 31st, 2018? And the answer to that is 0. What amount of sales was recognized in the quarter ending March 31st, 2019? That's the full $847,000. What's the total amount of sales recognized across the quarters? And so obviously that's the two added together, which gives us the same $847,000.